Hello, everyone, and welcome to episode 28 of JustDario Cigar Time. Today, we will be talking about taco and the real economy. Yes, you heard it correctly. While traders are caught up debating taco trading strategies, the real economy is capsizing. Let's break it down. First, what does this taco acronym mean? This new popular term on trading floor and social media, TACO, stands for Trump always chickens out. This debate among traders is so fascinating, not just because it's somewhat absurd, but because it highlights the broader issue of how traders now are just trading for the sake of trading, without any rationale attached to the real economy left. Right now, traders have their eyes, or rather their algorithms, glued to President Donald Trump's social media accounts, whether it's on Truth Social, X, or live interviews from the White House. And those who first grasp his words and correctly interpret his intentions effectively gain a competitive edge and can place trades in the market before anybody else and ultimately profit. Let's think about this for a second. On one hand, you have a president who isn't exactly known for consistency or sticking to his word. Recent events should have reminded everyone of that. Yet, his statements today carry more weight than ever for traders. They're hanging on his every word. But here is where things stretch the boundaries of common sense. Instead of analyzing the president's words to project potential global consequences, considering the pros and cons for the US economy, other economy, and assigning probabilities to various outcomes, traders are now fixated on capturing the immediate market reaction to his words. They don't care whether these trades have any rational economic justification per se. Of course, the same applies to the most popular mainstream media and the market moving headlines that still these outlets manage to send out. Even if by now traders and market participants should be wary of their reputation and, in particular, their reliability. What I'm trying to say is that we have reached a point where traders are primarily concerned with the emotions of other market participants rather than the fundamental meaning or consequences of policies, which is how it should be in theory. I know this might be hard to digest, but let's look at an example from this week. When headlines broke out about a US district court briefly blocking Trump's tariffs, the market reaction was overwhelmingly bullish for stocks. It took traders a while to realize two critical points. First, if tariffs were deemed illegal, then the US deficit as a consequence, because no income from those additional tariffs will likely worsen even more than anticipated. due to the upcoming big beautiful bill. As a result, Treasury yields should have increased. But it took about 4 hours for the market to figure this out. Algorithms and traders eventually caught up during the overnight trading. But this time gap is telling. It shows how a significant portion of the trading public is solely focused on the immediate impact that anything from the president, from headlines, whatever, can have on stocks, not on its fundamental impact. Specifically, they are laser focused on what could be the impact within the next 24 hours. There should be no surprise here, given the current frenzy around zero DT option trading that today dominates daily volumes. So while the FOMO on stocks was raging after that headline, fixed income investors clearly were taking a different approach. They digested the news and considered the real implication. Unlike short-term traders, fixed income investors who mostly buy and hold bonds for a limited profit, interest, but a potential 100% loss if there is a default, fixed income investors care a lot about long-term risk-reward dynamics. But it took them several hours to assess the news. Once they did it, they acted. That's when US Treasury yields resumed climbing, with the 30-year and 10-year yields in particular rising sharply. At that precise moment, when things started to become nervous again in the bond market, forget about stocks, they kept celebrating full of euphoria during all overnight trading, even including Europower, till US cash trading resumed the following day. But when things started to get nervous again in the bond market, timely reports from investment banks that for once they have been spot on began circulating across the media and the internet. These reports pointed out that under US rules and regulation, the district court's ruling was inconsequential. The President of the United States has a range of tools at his complete discretion to continue pursuing his tariff policies. But honestly, wasn't this the expected outcome from the start? We have seen judges attempt to interfere with politics or sabotage Trump's agenda multiple times. I'm not here to debate whether that's good or bad. That's another discussion. The point is, the administrative branch typically pursues its course, and the judicial branch eventually aligns with the set direction, especially when it comes to economy. Another intriguing event from this past week happened just before that tariff headline hit. Literally 1 minute before the market closed, someone placed an enormous trade in the option market, around 2 to 3 billion US dollar in long notional call position on the S&P 500, expiring by end of the week. And they nailed it. Were these traders acting on insider information? Were their algorithms so advanced that they detected a high probability of positive tariff news going through into the following day. I'm not here to speculate or argue. All I'm saying is it's all possible because the trading community is so narrowly focused on chasing short-term opportunities that their focus on extracting alpha now lasts for mere hours, sometimes minutes or even seconds. So we should get less and less surprised about these trades. That all they're trying to achieve is effectively just a quick profit. We have reached a point where the only thing that matters to many traders now is whether or not Trump will tackle. And while this is happening, the S&P 500 posted its best May performance in the last 35 years, defying the old adage, sell in May and go away. We know that retail traders bought the dip hard in April. But then, clearly, hedge funds tagged along and doubled down in May. So everyone is now fully invested heading into June, rather than using the opportunity to adopt a more defensive portfolio position. While traders are distracted chasing these very short-term opportunities, the real economy, as I said at the very beginning, is capsizing. First-time home buyers in the US are at record low since the tracking began. The real estate market is in an unprecedented state, with the largest ever gap between the number of sellers and buyers. And this isn't just a US issue. Similar trends are observable globally, although it's fair to say that the US has the most robust real-time real estate statistics. So we use them to infer on everyone else using their local data as a match. Mergers and acquisition activity, a key indicator of economic health, company efficiencies, and capital market dynamism, is at its lowest level in 20 years, lower even than during the darkest day of the 2008 global financial crisis. The German economy is expected to remain stagnant for the third year in a row. But let's be real, things are worse than they are portrayed. Public and private data on economic sector and sentiment, and in Germany and across Europe, show more and more a massive gap. Public data tries to downplay pessimism and bad figures and hide the dire state of the economy. But conditions are so bad that they can't fully conceal it without looking foolish due to the private data that keep coming across. In Japan, new CPI data for Tokyo, which often foreshadows national inflation trends, showed inflation last month between 3.5 and 3.6% across categories, and most of all rising again. Meanwhile, the Bank of Japan claims they are still fighting deflation. The reality is, Japan's GDP was negative again in the first quarter 2025. And paired with inflation data, all is signaling that the country is heading towards an inflationary depression. The Bank of Japan is in a bind. It can't normalize monetary policy without causing significant domestic or international damage. To address the fallout, from US tariffs, the Japanese government announced 900 billion JPY, roughly $6.2 billion, fund to subsidize affected corporations. Here we go again. Stimmy checks. Although this time sounds a bit reasonable, but where is the money coming from? Government finances are in deficit, and the country is no longer the world top creditor. Although, as we know, it's a title it held due to mostly exporting capital via JPY carry trade. Because on the other side, Japan has been effectively the largest debtor among the developed economies. So now what's going to happen here? The Bank of Japan again will have to print money to monetize this increase in deficit. So let's put all together and let's get to a broader point here. The disconnect between markets, the economy, and the various stakeholders is glaring. It's hard to justify rationally unless you accept that people are just chasing gambling type of profit as quickly as possible through financial markets. These people don't care about long-term consequences. They keep operating under the assumption that if things go south, they can exit safely with the profits. This assumption has been proven wrong over and over again, the last time in April, when hedge fund portfolios took a bloodbath. By May end, it was one of the worst year on record for macro hedge fund performances. Yet, despite these losses, many persist with the same flawed premises, dismissing the carnage that happened as a bump in the road. But was it? Or is this starting to be a trail of consistent missteps? Looking ahead to June, two things are likely going to dominate. First, by month end, it will be clear that the blanket extensions on US tariffs won't be met with a flood of trade deals between US and other countries. And this will result in the various problems and reactions that I described in previous podcasts and articles. The administration's strategy seems to be pursuing its economic agenda without spooking markets. Fair enough. They're testing different approaches, trading waters, so to speak. For example, last week, they announced 50% tariffs on the European Union, only to backtrack and grant another extensions when markets showed signs of seizing up again. But over this last weekend, after markets closed, the president announced 50% global tariffs on steel, effective June 4th. I suspect the administration will closely monitor market reaction, and if the response isn't too severe to this, we might see more and more sector-specific tariff strategies, targeting dynamics that traders can easily connect to a broader market impact, and then instruct their algorithms to chase the momentum and turn out a quick profit, as we saw before. I also expect the president to be more cautious in June about targeting specific companies. If he goes after a company like Apple, asking them to bring iPhone manufacturing back to the US, the impact on Apple clearly has been severe, but on the other side is manageable for markets, but also for the broader economy. However, if the administration starts targeting a series of companies critical to global market momentum, we could see again another market seizure in June. And not just in the US, but in Europe and Japan as well. Japan, in particular, is in a precarious position because while Europe is engaging in a tug of war with the United States, Japan is desperately negotiating. Its economy is so fragile that even 10% global tariffs cannot be digested. The US administration, however, is unlikely to accommodate this Japan pleas, as doing so could set a precedent for other countries to demand concessions, ultimately undermining the president's strategy. All in all, June is shaping up to be a messy month, with little major economic data expected or corporate earnings on deck. The focus will be on traders' perceptions on the trade front. The big, beautiful bill and its impact on US debt refinancing and deficit will be important. But for traders, the short-term market reaction to trade war developments will capture most of the attention. These people are not concerned with which economies will benefit or suffer long-term subject to the development. As I say, they're chasing immediate signals, and sometimes we can clearly see there is some narrative fabrication to achieve specific trading goals. That said, some investors are starting to wake up. Be careful. People are realizing that companies like NVIDIA, which I have heavily discussed in the past week, published an article, tweeted a lot about that. And this type of companies aren't performing as well as they want to portray, heavily cooking their books. Portfolio managers, especially in fixed income, are taking a step back from all this short-term noise to make decisions that will impact their portfolios over the long term. Liquidity is tight, and the frenetic stock market action is becoming so distracting. The reality is that economies are already in recession, and as I said many times, if we get the real statistic, likely they have been in recession for a while, and things are improving. Furthermore, geopolitical tensions are rising, government deficits and debts are ballooning, and there is no sign anything is going to change. Those who remain fixated on the taco debate again risk a major misstep, like all those hedge funds that got hammered in April and May. Traders need to think harder about positioning themselves for what's coming. And here is where I leave it for today. Thanks for tuning in to JustDario Time again this week. I appreciate your likes, comments, and subscriptions to my channel, your support on X, and I really appreciate you reading and commenting my articles on JustDario.com. I wish all of you a great week ahead.